Hi, my name is Roger Schluter. This video is actually about other equity financing and includes incubator financing or incubators, which is not really a form of financing but a form of saving money for a business. This is the fifth part of a five-part video set on financing your business. The five parts are bank financing, personal ways, other financing, crowdfunding and peer-to-peer financing, other equity and incubator financing, of which this video is. So anyway, the video is actually on other equity financing, including incubators. This video is about to show how to finance your business through other equities such as angel investing, incubators, venture debt, private equity, and public equity. These types of financing are all called alternative financing because you're getting funding outside of the traditional bank financing. Angel investing. Most angel investors give financing to small businesses in return for equity in their business. Angel investors want your business to succeed because they will cash out at some point down the road in the form of either kind of a public or private offering, usually a private offering, or just a straight buyout by a large company. That happens a lot too. Angel investors are kind of a little bit smaller companies than like venture capital. So anyway, they usually help. Will usually help in the form of mentoring or management, to help your business succeed. So they really do form a great thing, and a lot of times venture or angel investors are small investors who are going to invest in 3 or 4 businesses at a time, and they hope 1 or 2 of them really makes it so they can cash out on that business. So anyway, but they usually want to help the business a lot more than some of the other ones. They want to help the business to do well, and hopefully then they'll do well too. The next one would be startup incubators. And I know this isn't a type of financing, but you do save money. Incubators are buildings or real estate that will rent you space, usually a small space in a larger building. The building will have other businesses that are also starting out, and it will also have a management of that building. The management of the building will offer some amenities, usually like answering service, copy machine, internet, conference room, telephone, and then sometimes many other services which can be used by all the incubator tenants, to save the new business money. Some incubators also provide mentoring, counseling, and legal services. So the management will at some point want your business to graduate from the incubator, at some point in the future. And sometimes these incubators, there have been a number of them that are for profit. A lot of times they're run by cities or by public entities that aren't trying to make a whole lot of money off of them. They're just trying to get the companies to grow an investment and hire more people. That's their biggest goal, is usually to get more investment out there, and then also to hire more people in the community. The next one would be venture capital, and that can be in debt or equity. Venture capitalists are a lot like angel investors, but venture capitalists are usually established companies that invest in startup companies and some other companies that are ongoing, but they will definitely take an equity investment, and usually this is an equity stake, and usually be controlling interest, like 50% ownership. They are for high growth companies. Venture capital really wants to make money off of this company, so they want them to be a what they consider a high growth company, or they consider the venture capital company can make them a high growth company. They will make you take their advice because they own 51% of your company or more, and then and management help, and they a lot of times are looking ahead to take the business public in order to cash out of the investment. Now, this could be a year from now, could be 10 years from now. It really depends on the company and the products and that. The company will absolutely give up a lot of ownership using venture capital, and almost all the time they'll give up controlling interest in the company. So anyway, be careful with the venture capital. Private equity. Private equity is a company taking an ownership interest in your company, and even sometimes they'll just buy the whole company. Private equity's goal is to sell out the company for a profit sometime in the future, similar to venture capitalists. They sometimes use borrowed money to purchase a company, purchase it outright. And that is why a lot of the projects are called leverage buyouts, because the company will borrow money to buy this company. Now sometimes, that isn't necessarily. They also do established companies, and they've been known to do companies and break them up and sell off the parts. But they will do new companies also, or at least high growth companies that haven't been around too long. Public equity. Public equity is the ultimate, I guess. Public equity is to have a bank or investment firm take the company and start trading its stock on a stock exchange. Then it is called a publicly traded stock. In a publicly traded stock, almost anyone can purchase, the company's stock on the stock exchange. Publicly traded stocks have a higher transparency because they really have to show financial information and company information quarterly and annually to the Securities and Exchange Commission and make this information public. And because of this, there is a high cost to being a publicly traded company. And that is why a lot of companies, rather than take the company public, they might just go ahead and let the private equity take it, and then they'll either sell it to another company or something. And you can take the company not public, but you can start create a company where shares, it's a private company, but it still can have shares of stock and ownership in it, and the stock can be worth something. I remember I worked at a bank, and they private companies, I know one of them that they would definitely lend on their stock was UPS, because UPS at one time, they're public now, but one time they're a private company, and they issued stock, and the employees got stock. And a lot of the bigger banks would go ahead and would go ahead and lend on that stock, and that's how much they thought of the company UPS, because UPS was not a public company. So anyway, at that time. So anyway, that is another way to do it. And actually with a company, going public would be the ultimate, I would think, for almost any company in the United States that's starting out or that's, got high growth potential. Startup incubators are for, small companies, with angel investors being interested shortly thereafter. Venture capital and private and public equity is for more established companies. They can still be small, but they must have the potential to be highly profitable with high sales and high earnings. Please subscribe to the channel and hit the bell icon to notify you of future videos. And if you receive any value, I hope you would also like the video. That actually tells YouTube to share it to more people in that. So it is very, very good for our channel anyway. My name is Roger Schlueter, and I will see you in the next video. Thank you.